Welcome to Risk Matters, the insurance podcast brought to you by DWF and your global guide to the latest trends and issues in the insurance and reinsurance industry. Join us as we explore topical issues, emerging technologies, and the innovative strategies that are shaping the global future of insurance.
Welcome to Risk Matters, the insurance podcast from DWF. My name is David Abbott, and I am the head of the political risk, trade credit, and political violence insurance team at DWF. Today, our topic is Ukraine. As the war has now entered its third year and Ukrainian forces continue their defense against the Russian invasion, we're going to discuss how the Ukrainian economy is faring and how Ukrainian businesses are adapting to the war. We're also going to explore how insurers are responding to the ongoing conflict and what role insurance can play in helping to support the Ukrainian economy and ultimately help with the rebuilding once the war is over, which, of course, we all hope will happen as soon as possible. I know this is a topic that is absolutely at the forefront of people's minds across the London market and insurance industry generally, and particularly in the specialist political risk, political violence, and trade credit fields. So I'm looking forward to this conversation. So I'd like to introduce our guests today. Firstly, we have Olena Savchuk and Igor Krasovsky from Integrites, a Ukrainian law firm, who we at DWF have worked with on a number of projects. We are very fortunate to have them with us, and they are joining us from Kyiv in Ukraine. Igor and Olena, would you like to tell us a bit more about yourselves and your practice?
I will start then. So I do banking and finance, and I lead a team of finance lawyers at the Kyiv office. We do regularly advise our clients on different cross-border finance transactions, including we have a lot of clients who are the insurance and reinsurance companies. So we would be more than happy to share some insights into the Ukrainian business and how the insurance is currently doing in Ukraine.
Thank you for having us today, and we are so lucky to be able to cooperate and to work with our esteemed international partners and friends, and I hope that we'll be able to shed some helpful light on the topics that we will be discussing today.
Thanks, Olena. I'm also very fortunate to have with me Nick Headley. Nick will be very familiar to any of our listeners that have worked in political risk, violence, or trade credit. But perhaps for those that haven't come across you, you could introduce yourself, Nick.
Yes, thank you. Well, I've got about 40 years experience in trade credit and political risk, both as a broker and mostly as an underwriter. I headed up JLT's political risk and financial lines division in the noughties. I moved to Latin American underwriters after that. AWAC bought Latin American underwriters, and most recently I was head of political risk at Optio. My training really was 10 years at AIG in the 80s and 90s.
Thank you very much. So, as we're discussing the response of the Ukrainian economy, Ukrainian businesses, and insurance possibilities there, I thought we'd start with some context and some background around the Ukrainian economy, which I'm very pleased to say is actually responding better and is in better health than a lot of commentators thought it would be. So a few stats. The National Bank of Ukraine states that the Ukrainian economic growth over 2023 was 5.7% against a 23 forecast of 0.3%. The IMF and National Bank of Ukraine project further economic growth of 4% in 2024. This, however, is against the backdrop of a significant fall in GDP in 2022, which is obviously to be expected. Inflation is at an estimated 5%. The IMF baseline estimates suggest that the Ukrainian government's financing gap between revenues and expenditures will be USD 85 billion up to USD 104 billion from 24 to 27. The World Bank, the Ukrainian government, the EU and the UN have estimated the reconstruction and recovery costs for Ukraine at approximately 486 billion US over the next decade. The IMF, as well as the EU accession process, are requiring structural reforms to the Ukrainian economy, including on fiscal policy, governance and anti-corruption as part of their application to join the EU. So that's an interesting economic mix for us to act as background to our conversation.
David, could I just add one statistic to that, which I read this morning, which I believe to be accurate? I mean, the cost of the Russian aggression has led to debt to GDP ratio increasing from under 50% in 2021 to just under 100% today. So there's massive debt has been piled up as a result of the Russian aggression. And of course, you add now $480 billion of reconstruction cost. We're going to come on to this later, but there is a significant financing requirement that arises from all of this.
And how the West in particular copes with that debt and what they do with it is going to be at the core of what happens next, I expect.
Yes, indeed.
So we'll just start by focusing on the economy, and a question for Integritas around their clients and what you're experiencing in the market that you're in right now. What are clients telling you about their experience of doing business in Ukraine in 2024? How are things?
So surprisingly, but despite the ongoing war and a great level of uncertainty about the future, the business activity has been growing after the economy slumped dramatically in the early days of invasion. And I think that this became possible due to continuous support of the key allies of Ukraine, including the United States of America, United Kingdom, and European Union, as well as many other countries, which have deployed various programs and initiatives aimed to support business in Ukraine. In addition, the international financial institutions and the development banks such as EBRD, IFC, DFC, and MIGA also play a very crucial role in providing necessary emergency financing for the Ukrainian business and providing the coverage against the war risk for local and then foreign investments in Ukraine. Another, historically, Ukraine is one of the largest exporters of the commodities, and therefore a turning point was when all the main Ukrainian seaports were unlocked and open for trading, for exporting grains and commodities. And of course, the business currently and our clients, they do work in a very challenging environment because of the regular airstrikes, because of the relocation of employees and the staff, because of the strict capital and exchange control laws, and some losses they also incur directly as a result of the war. However, overall, the situation is much better for our clients compared to 2022. And some of our clients who are the big international companies, they reinvest their profits again in Ukraine, and they expand their presence in the Ukrainian markets. Some of the clients, they make new investments and launch a completely new construction and projects currently in Ukraine. Most of those projects are located in the eastern and western parts and are distant from the front line in order to reduce risk. But I would say that we see a tremendous resilience of the Ukrainian business and a tremendous resilience of the foreign business which is present in Ukraine.
Interesting. And just to follow up on that, obviously there is a very big difference between areas that are near the battlefront and areas that are further to the west, Lviv, for example. Are foreign investors clear about the distinction? Are they happy to invest in the areas around Lviv and so on? Is business around there, is there a certain sense of things being normal around there, or is the entire country affected?
So because of the airstrike, technically the entire country is affected because the airstrikes can be in Lviv, in the very western part of Ukraine. But still, of course, the risk is more low in the central and eastern part, in the western part of Ukraine compared to the eastern and south Ukraine. And usually what we see, some of the clients, they do have a very strict policy that they are allowed to invest in the central and western part of Ukraine, but they are not ready to take some additional risk in those areas which are near to the front line. That's true. But some of the clients are more willing to take additional risk and ready to invest and do projects even in the eastern part of Ukraine, especially if those projects relate to critical infrastructure.
So you are seeing, in fact, a number of clients, a number of people willing to do business in the Ukraine being brave about the risk in the Ukraine and being serious about the potential for the future in the Ukraine?
Yeah, I would say that, I can't say that there are a lot of new foreign companies coming into Ukraine these days because of the risk. But the good thing is that those companies which were doing business in Ukraine before the war, they continue to do business now. So they continue to invest more or reinvest their profits. And I think it's already a good achievement. So we are mostly not talking about new business, but about the existing business and the continuation of the activities in Ukraine.
So what I'm hearing is that the challenge is in fact now and possibly going forward is the attraction of new companies and new businesses, new finance. They perhaps have stepped back at the moment, but it's encouraging those people into the Ukraine, whereas with existing businesses, they're actually still committed.
Yes, exactly. You're quite right. And I think that the biggest challenge for the new companies and for the new investors is the country risk and is the war risk. And until and unless there will be a strong instruments available to mitigate those war risk, obviously there won't be a lot of companies willing to invest in Ukraine. I mean, new investors.
So obviously, which we'll come to with Nick in a bit, but it sounds then like the insurance industry has a critical role to play in encouraging new investors in.
Can I ask what sectors you're talking about? Mainly the existing investors who are increasing or reinvesting their profits. Is any particular sector? Is it manufacturing? Is it agriculture? Is it retail? Or all of the above, I suppose? Perhaps you give us a sense of what industries we're talking about.
So, the Ukraine is very well known for the agriculture, and obviously most of the investments or reinvestments are made in the agriculture sector, first of all, because, this is the agriculture and the export of soft commodities remain to be the main income of foreign currency in Ukraine. So basically, the agriculture companies, they affected badly, but they still continue doing quite well. Another, sector would be energy, because energy is traditionally strong in Ukraine, and because the energy network was targeted by Russians, a lot of investments were made to repair the electricity network in order to provide additional resilience and to invest in some, renewables like battery storages and also renewables capacities in order to respond to the demolition and destruction of the traditional energy.
It's actually very interesting because we see many agricultural producers expanding their operations and trying to conquer new sectors and new markets and trying to expand to new international areas. For example, many of the producers who only exported, they started food processing, and they started building silos, and they started storage facilities. So this might be about diversification, but also about expanding and about trying to navigate through the challenging circumstances.
You mentioned sort of new opportunities there. We're at one of the main political risk trade credit conferences called the X-Cred. And the view there seemed to be that there is a loss of liquidity in Ukrainian banks and that there was actually a lot of potential finance available for new businesses and a reduced need for trade credit finance from outside. Is that something you're seeing, or was that people not interpreting things correctly at the conference?
Well, speaking about barriers, there are some. Actually, the biggest barrier is probably currency restrictions, which were put in place from the outset of the full-scale war on the very first day. But while companies do face difficulties, they remain committed to honoring their contractual obligations. From our experience, we see that many companies try to negotiate restructurings and try to speak to their lenders and try to do business as usual to the fullest extent as it is possible. And the legislation is also evolving. There are barriers, but the legislation is adapting to the challenging environment. For example, starting from the February 2022, the restrictions that have been in place since then are not the same anymore. And the biggest task of Ukrainian government and of the central bank was always to help producers from Ukraine to do business and to export and to produce and to manufacture. So I would say that the legislation has evolved to account for that and to give them the opportunity to work and to continue trading with their partners. Another example is the work of the Ukrainian Export Credit Agency. So starting 3 years into the big war, they have been given the right to insure and reinsure local producers as well as foreign companies entering the market, and to reinsure, which is something unheard of, actually. This is new, this is a novelty. And all of us are expecting we are fascinated how all this would work. But this is something which signifies a great development and actually a great resilience, that new mechanisms like this evolve.
The other thing that was mentioned at the same conference, and Nick, maybe you can comment on this, but the other thing that was mentioned was there is some interest from export credit agencies. I think Canada and Belgium looking to underwrite some deals in Ukraine. Is that something you've seen?
Yes, that's what I read and that's what I understand. But I think it's mostly short-term, 30-day, end of month, following month type invoices. It's not. I think if you went to the market with a 3-year prepayment, for Metinvest, for instance, that would be absolutely uninsurable at the moment. But I think short-term trade credit, that there is probably some appetite there from the ECAs. I don't think there's much in the private market, though. I think the private market is almost completely closed at the moment.
So some ECA short tenors and anything with any length looks very difficult right now.
Yes, that's right.
And is that what you're seeing from the Ukrainian perspective, Elena and Igor? Are you seeing any export credit agency activity in the Ukraine? Are you aware of that from the business perspective?
Well, as I just said, we see the demand for ECA coverage, and it's growing. The Ukrainian ECA is currently entering, so to say, the market, and it is planned that they are going to be insuring and reinsuring local market as well as foreign companies who are looking to invest into Ukraine. If you speak about foreign ECAs, in our experience, they were mostly willing to work with the foreign subsidiaries. Even when the company was beneficially owned by Ukrainian owners, they were looking into working with foreign subsidiaries, and that was the experience even before the full-scale war. But still, the limits are too low, and even if we see the demand, I can confirm that there is a demand for ECA coverage, but the limits are not sufficient, unfortunately, to cover the growing limits, to cover the growing demand, given the risk.
Elena, can I ask you to elaborate? Where is the demand? Is it for short-term imports into Ukraine? Is it for long-term export finance? Is it for foreign direct investment? Where is the unmatched demand in Ukraine? Where are the Western European ECAs not providing the support that's needed?
Most of the clients we have worked with were inquiring about short-term financing for their cross-border trade operations. So OPEX for trade with Ukraine or inside of the European Union. So we are mostly speaking about several millions or 10, 20, 30 million euros, something like this. So this is the coverage we have mostly seen. But as I said, the demand is growing. So the ECA coverage could be an unlimited opportunity for Ukrainian companies and Ukrainian producers to work with Europe and the rest of the world.
Right, so it's short-term trade credit where there is most need.
I would like to add just a quick point. Yes, you're right. Mostly the ECAs, they provide the short-term credit or credit coverage, but there are some ECAs which have appetite for the so-called long-term sovereign or sub-sovereign risk. For example, we've been involved in a number of the deals where, for example, UK expert UK Export Finance covered a long-term financing to the Ukrainian government or to the sub-sovereign enterprises to cover the war risk and political risks, actually. And the financing was provided to finance the reconstruction of the roads and the bridges and some other infrastructure objects in Ukraine. So basically, yes, there are short-term credits available from ECAs, but there are also long-term transactions which are covered by some of the ECAs. In addition to the UK export finance, I would also mention BPI France, and BPI France is very active in covering the risks of the French companies doing business on Ukraine or investing in Ukraine, including long-term projects.
Thank you. That's probably a useful moment to turn our focus more completely to the insurance market. Igor, Elena, I wonder if you could perhaps just give us a brief overview of the Ukrainian insurance market as it is today and how it's changed since the start of the war.
Before 2022, the insurance market was pretty much growing pretty much steadily because we've seen that more businesses and more individuals were buying insurance. Insurance companies offered various types of insurance for life and health and property and liability. And I myself cannot recall a year in my professional life when I didn't have the benefit of some insurance coverage included into the corporate package. Since February 2022, the insurance market in Ukraine has been greatly affected by the war, and obviously there has been a lot of damage and loss of life, unfortunately. So there are many insurance claims and many insurance events, especially for property and casualty. Despite the challenges, the insurance companies have been trying to adapt and trying to keep up with the times. I don't know about any cases on the market where insurance companies were rejecting insurance cases which were connected with the war, because the intention seems to always be to negotiate and try to understand the situation of the insured, which is obviously a good thing. In general, statistics show that the insurance premiums for various types of risks in 2023, they nearly equal the premiums in 2021, so pre-war situation. And if we speak about indemnities, the same applies to indemnities. So they nearly equal the situation which was before the full-scale war. And I've even seen that property insurance premiums have increased by approximately 40 or 50% as compared to 2022. So in 2022, we experienced drastic decrease in indemnities, but in 2023 the situation seems to be back to almost what was before the war. And part of this growing demand is for the political insurance. Some of the insurance companies in Ukraine already provide this type of coverage, but obviously there is a much greater need for the international players to join this effort. Well, it's interesting that 3 days into the big war, the regulator, the National Bank, has put a lot of restrictions on cross-border capital flows, but then they started relaxing the restrictions, and now there are many opportunities for insurers to pay abroad and to pay reinsurance premiums and to work and continue working. The regulator tried to incentivize all of the players to use the electronic document flow, to minimize the list of the documents, the evidence which are requested from the insurers and so forth.
That's very interesting. So what I'm hearing is that actually since the start of the big war, domestic insurance market is actually in good health. Premiums have re-established themselves. There's business going on. I assume people's everyday lives are being insured as they were before, but the real rise is in war-related products, which, as I understand from what you're saying, since the big war started in Ukraine, the local market is developing those insurance products to meet demand. There is, though, a demand gap which Ukraine is hoping will be filled by foreign insurers and foreign investment. Is that right?
That is definitely the situation. There are various challenges the market is facing, not only physical challenges like the damage and political instability and the changing legal environment, but also uncertainty about whether we are going to expand the market, or should we freeze it, or should we stabilize it and then think about expansion after the war ends. So yeah, there is a lot of uncertainty actually, but the market is trying to adapt, which is really a good thing. And we're speaking to many insurers who are trying to collaborate, even to provide joint insurance on a joint basis and on a syndicated basis, and trying to look into this direction. While we are waiting for our doors to open to international cooperation and international players and foreign reinsurance, the market is trying to survive and keep the ball rolling.
Well, it sounds like another example of Ukraine's incredible adaptability and bravery in the face of the war. So that's very good to hear. Not actually what I expected to hear, but that's very good news. You mentioned claims. Nick, perhaps you could just give us an overview of your view of the claims that have been happening in Ukraine that have been paid out by the London market, how that's gone.
I'm going to sort of break this down between claims for political risk, which is where the insured loses the asset, whether that's due to a war risk or whether it's due to abandonment risk. And I'm going to distinguish that between the political violence claims, where there has to be an element of physical damage to the goods. So as I understand it, talking to loss adjusters, the headline figure of about $1 billion is what I'm hearing in terms of paid claims. People talk a lot about 4 wind farms which have been destroyed, and there are some substantial claims that have been paid for that. But I'm also aware of sort of retail operations which have been affected. And of course, the commodity traders with grain in the Black Sea ports, they've had substantial losses. So that's the overall picture, both political violence and political risk. The situation is perhaps not entirely satisfactory. Whilst there's been fairly good performance in terms of responding to claims where the assets have been physically damaged or destroyed, there are some problems in 2 areas. The first area is business interruption. The example was given to me recently that you might have relatively insignificant physical damage to a wind farm. Maybe the generators or the cables get damaged, but if you can't get in to repair the damage, which you can't because of the war situation, then the business interruption loss is potentially huge. I know that one of the concerns that Elena has raised with me in the past is the risk of blockade in the Polish-Ukrainian border. Blockade is essentially a business interruption loss, and that hasn't been adequately covered. Our market is very resistant to covering business interruption in addition to political violence or political risks. So that's one area where I think the product isn't responding very well. There's substantial business interruption losses, and they haven't really been covered satisfactorily.
I assume, just dealing with that business interruption point, that economics is the basis of the nervousness around business interruption. I mean, if you compare it with other markets, if you compare it with, for example, the energy market, in your average onshore energy loss, the business interruption will often far outstrip the physical damage.
Exactly,
and really the whole loss and the adjustment of the loss will be in large part about the BI. So obviously once you start adding BI, which, as I say, from the lawyer experience, it's absolutely not the case that BI always appears to be covered. Sometimes it's in there, sometimes it's not in there. But once you start adding BI in, unless you're limiting it very clearly, then you're in a different game really there.
Well, it needs to be sublimited. There needs to be limits there, but frequently in the political risk market, it's just excluded, or it's very difficult to. At Optio, when I was writing the political risk account there, we had, I think, the widest form of business interruption in the market. So, for instance, forced abandonment is one of the standard political risk perils, and it's been obviously a trigger for a number of losses in Ukraine, where the assets aren't destroyed, but because of the Great War, you have to abandon those operations. But normally to get a claim paid for forced abandonment, you have to abandon the operations for minimum of 6 months, and it has to be a permanent abandonment, and then the insurers will pay the value of the investment that has been walked away from. But in fact, what generally happens is that the abandonment doesn't last for forever, and the insured can go back and reclaim the assets and resume production. So therefore, the loss is really essentially a business interruption loss, and we covered that at Optio. So I've always been trying to push the boundaries of the political risk product so that it does include perils like business interruption more widely than perhaps the market is comfortable to do. And I think it's something that needs to be dealt with.
It's always the case that new situations, and certainly a land war, significant scale land war in Europe, is a situation we haven't seen for a long time, challenge the insurance, newer situations challenge the insurance products. I think just staying on BI for a second, something that I think the market has seen, and you may be able to comment on this, Elena and Igor, is that the business interruption is triggered by physical damage. And where the war sweeps past, let's say an energy plant or a turbine plant or a grain storage facility, something like that it isn't necessarily damaged. It just can't function because it's occupied by Russian soldiers. There's a clear loss going on, but it's difficult to identify the trigger for the business interruption. Or equally, just to finish on that, there may have been some action around the energy plant I'm giving as an example. They may be able to identify some damage to the plant, but if it's not a significant part of the plant that's damaged, if that damage doesn't actually stop production, then it's difficult to say that the damage has caused the business interruption, because the damage isn't actually causing the plant to stop working. It's the occupation that's causing this plant to stop working. So that's that relationship between, firstly, you need damage, secondly, you need the damage to cause the BI, has produced some problems in examples in Ukraine.
But before Elena comes in on that, because I know you wanted Elena to comment on that, if I could just make one other point. I think that the political risk product needs to cover non-damage BI, and we did do that at Optio. We had business interruption arising from forced abandonment. I think the blockade situation that Elena has spoken to me about in the past, there hasn't been any physical damage, but there is a significant business interruption. So I think in the context of political risks, I think the market needs to look at the whole question of non-damage BI, because I think that the non-damage BI is just as prevalent, just as important as physical damage resulting in BI.
The broad market, of course, has been extremely focused on non-damage BI because that was at the core of the COVID losses throughout the UK. So that's certainly their mind is working on that, and absolutely we should see whether it applies to other classes. Elena, Igor, do you have any comments on that?
I actually wanted to ask you a question. When you speak about this non-damage related business interruption, this all sounds so exotic and unheard of, but I think that, as you rightly said about COVID, right, we are living among the exotic events, and nothing like this had happened before. So can you think about any examples, or maybe in your past experience when you've seen something like this being applied, being developed in some countries affected by diseases or wars or some political event?
Well, it's not. Well, Nick will correct me. He has a far deeper understanding of the market than I do, as I'm a mere lawyer. But an example of I haven't seen a lot of examples of non-damage BI in the sort of political risk context. But a classic sort of example would be if there is something which is preventing the business from functioning. And that something may be a denial of access to the business. So a lot of hotels in the Gulf of Mexico region have non-damage BI cover. It's often called, for example, denial of access cover, in order to prevent against a situation where they are not themselves damaged by, let's say, a hurricane, but there's a shutdown and nobody can enter the town, or you can't get to the town. So that might cover things like hurricanes and floods. You've also, following SARS outbreaks in Asia pre-COVID, you had some covers which provided cover for customers being prevented from coming to the business. And there is some cover out there if reputationally people are turned away from coming to a particular place. So that's the sort of non-damage BI has tended to be around businesses which attract customers which require footfall, and that stops. In fact, it may actually also cover energy plants and those sorts of production units that require workers to arrive if they can't arrive and do the work. But I haven't personally dealt with one of those, so we could look into that. But I haven't seen it in a political risk context. Okay, we've just been talking about the potential difficulties with provision of business interruption insurance in the political violence, political risk context. I just wondered, Olena and Igor, whether or what you have seen with regard to the payment of political violence claims in Ukraine, and what, if any, difficulties you have observed with those payments.
So basically, in our experience in the early days of invasion, the insurance and the reinsurance companies didn't rush to pay out the compensation. And most of them decided to wait and see how the war develops. And I think that the key reason for that was that at that moment, no one was sure what's going to happen next. And, some of our clients, they lost assets because those assets were occupied by the Russian military. And they make a claim to the insurance and the reinsurance companies to compensate for those assets. But I think that the reinsurers and the insurers were not sure if the companies wouldn't be able to get control over their assets as a result of the counteroffensive. And therefore, they didn't actually pay the compensation, but decided to wait. And as far as I know, not all of the insurance claims have been yet paid by the reinsurance companies, because a lot of them, they really look into the documentation of the damages. They struggle with confirming, all these damages caused to the property, because there is no access basically to the site, there is no access to the projects, etc. So I would say that partially the claims of our clients were settled by the insurance and reinsurance companies, but most in relation to the projects where the foreign lenders were involved. Usually the lenders, they take security over the insurance and reinsurance policy, and they have a leverage over the insurance companies. And when the borrowers, our clients, received a full support from the lenders, they were able to get paid. But some of the clients, they still wait for their claims to be settled by the insurance companies. Why I'm talking about insurance and reinsurance? Because usually the Ukrainian companies, they just take 1% of the risk. And the rest of the risk related to the project is reinsured by the foreign reinsurance companies.
So foreign reinsurance companies, you're saying, have been asking for proof of damage, which of course is very difficult to prove because you can't get adjusters in there and photographs and so on.
Yes, and that's true. And I think that we assisted a lot our clients in collecting the evidence of the damages caused by the war. And I think we tried to document it as detailed as possible, and we used everything we could. So photos, videos, even those which are in the public domains, for example. All kind of documentary, video and photo damages, I think, was used by our clients in order to prove that the property was damaged.
So Igor, are you seeing insurance companies, foreign reinsurers, being prepared to accept that there is damage without necessarily visual proof if the loss is occurring in or near the battle zone, the battlefront?
Yeah, I think that's the case because still the clients were required to provide some evidence or confirmation that the damage was caused to the property. But basically, yes, the insurance companies were very supportive, and reinsurers actually, and they accepted claims even without the sufficient evidence of damage. That's clear, because at that moment it was really impossible. It was unfeasible for the companies to collect necessary damages. You can't send people on the site in order to make a photo, in order to document. Probably some of the companies managed to do that, but for some it was completely impossible. Those claims were not questioned based on the lack of proof of damage.
You know what's interesting? On the one hand, all insurance companies are regulated, right? So the next day, the regulator could come and penalize them for paying something without the evidence. On the other hand, it's all negotiable. So there is a contract, there is some room for negotiation, and I'm actually wondering how it's dealt with in London, on the London market, whether the insurers are able to accept the claims that are not fully evidenced by documents and photos and so forth. Is it something carved in stone or typically not?
Well, perhaps I can take that point. I've spoken to a number of loss adjusters in recent days about how they've managed to adjust political violence, physical damage losses in Ukraine. And they have to take a pragmatic view. Satellite imagery is helpful. That will just demonstrate whether the assets are damaged or not quite easily. And I think just a certain amount of goodwill on both sides. There has to be some understanding that the normal standards of loss adjusting just aren't going to be possible in a war zone. I haven't heard of any situations in London where legitimate claims have been held up because the loss adjusters were not able to get satisfactory evidence about the nature of the physical damage. I don't think it's been a problem. I think adjusters and underwriters have been quite pragmatic. I don't see it being a problem. I don't think it has been a problem.
I would agree with that. And I think, so firstly, there is no regulatory requirement on insurers. It's very much at the discretion of insurers as to when and how they pay a claim. I have seen insurers paying claims without the usual adjustment evidence. Where things get more difficult is where losses are further to the west, or if there is a list of losses coming through from an insured and it's not clear where those losses are, and some of them may be near Lviv, for example. The ones that are near the Eastern Front are, generally speaking, have not been questioned as far as I can see, but the ones that are further out require some, at least, commentary on how they were damaged and where they were damaged. I think in the London market and international markets, probably the main issue with affecting the discretion of insurers is that, of course, most of this is fairly heavily reinsured. So insurers have to act with an eye on being able to show reinsurers that the losses they're paying out are covered, or at the very least making sure they're bringing reinsurers along with them on the adjustment path. And that's really the main thing that affects insurers' actions and affects their discretion. It's probably a good opportunity, as we talked about that, to ask Nick what challenges you see the war in Ukraine has presented to the market, and how you think that may affect the product or the development of the product.
Right. I don't think it's just Ukraine. I think there have been 3 loss situations in recent years that have shone a spotlight on the efficacy of the PV and the PRI products. Afghanistan being one, Russia being another, and Ukraine being the final one. I think it's important to remember that the standard PRI product has its origins in a 1981 form, so it's a very old, very well-established product, but it was designed to cover the sort of 1980s style of snatch and grab expropriations where the government of Peru seized American oil assets. I don't think it's kept pace very satisfactorily with the sort of more disingenuous ways that governments tend to act nowadays if they want foreigners out of their economy. So I think that the first problem is, I think that more thought needs to be given to bringing the product up to date. I think a second problem that we've seen is in the political violence area, where companies go for the cheap option, which is just to buy a political violence policy rather than political risk. They're frequently surprised when, because of political violence, they have to abandon their assets, and they submit a claim, and the claim isn't honoured because there's a requirement that the assets have to be destroyed or damaged. But the wordings perhaps aren't as clear on that point as they want. So I'm aware of a number of coverage disputes centering on abandonment rather than physical loss or physical damage. So that's another problem. So my general takeaway from all of this, and I think in the issue in Russia, where we've seen companies having to abandon their operations, not because they've been ordered to do so, or not because there's any sort of imminent threat to human life, but just for commercial reputation reasons, it's essential to do so. And again, that isn't obviously covered under a political risk policy. So, combination of voluntary divestiture when the political climate becomes too hot to handle and reputational issues crop up, abandonment rather than physical damage, business interruption and non-damage business interruption. There are a number of issues, I think, that have come to light over the efficacy of the political risk product and to a lesser extent the political violence product over the last 4 or 5 years. And I think this is because the market has been focused almost entirely on insuring bank loans for the last 15 years, and they've really tended to sort of push to one side the traditional political risk product for corporate clients rather than financial institutions. Whereas a huge amount of work has gone into updating the bank product range, Basel II, Basel III, and now Basel IV. So you have a really watertight guarantee, and that was just demonstrated very clearly in the way the market paid all the non-payment claims following the Ghanaian sovereign default recently. But set against that, you've got the political risk product for corporate assurance, where not much attention has been given to bringing the product up to date, making it more of a watertight guarantee when things go wrong. And I think, looking to the future, when the war is over and reconstruction of Ukraine starts and foreigners hopefully surge back into the country wanting to fund the infrastructure developments, I think they're going to be looking for an improved product rather relative to what they're being given today. I don't think the product really is as fit for purpose as it needs to be.
That's interesting, and I think from a lawyer's perspective, from the perspective of the market, it's always difficult where you have a cover which is triggered by specific perils as opposed to, for example, an all-risk cover. The definition of those perils is obviously critical to identifying that there's cover, and you have to apply those definitions to an entirely fluid and ever-changing environment. So each new thing throws up new issues to which we have to apply static, defined perils in a policy. So I see what you're saying. It'd be interesting to see how you define when one could recover for a voluntary divestiture, because, of course, there's a whole range of
moral hazard
yeah. and reasons for no longer being in a country.
But against that, David, I think it's, you could clearly say that in the case of Russia, there can't really be any doubt. I mean, a layman's view would be pretty much what I think a market practitioner's view would be, that it's intolerable to carry on operating in that country for all sorts of reasons, and therefore it would be perfectly legitimate to pay a claim for abandonment of those operations. I think there is a way of doing this without sort of exposing underwriters too much to a moral hazard type situation where the financial motivation for the investment has been lost due to whatever. I think there's a way through this, I believe.
I think just because it's challenging doesn't mean the market can't step up to meet it, because the market has always dealt with the difficult borders between, is this economics, is it politics, is it individual failure of a business, or is it from the outside? So those are challenges we've always dealt with, and I don't see the reason to step back from development because of that. Could I just ask, following on from that, talking of things that aren't necessarily covered by political risk and political violence, the blockade on the Polish-Ukrainian border, I just wondered, can you give us an update on that, and is there an insurance involvement in that from a Ukrainian perspective, Igor and Elena?
Well, that's a tricky question. I don't think we have a ready-made solution for that yet. And it's even difficult to qualify it. Is it a strike? Is it civil unrest? Is it some demonstration? I don't know. The blockade on Polish-Ukrainian border started on November 6th, 2023, so last year. Polish farmers were claiming some unfair competition, so we will not dive into that deeper, I think, because there are many speculations and allegations. Since then, hundreds of thousands of businesses have lost time and money, and even there were deaths on the border, resulting in major losses. So this is something which definitely needs a solution. And I think I simply do not see any other way rather than having it covered under the political risk insurance, because it causes so much losses, and it's a situation which could not be predicted. And in fact, it can occur on other borders across the world, right? So this is not something related particularly to Ukraine and Poland. This could happen anywhere. Currently, the estimated losses or damages are around 200 million US dollars and still growing. So this is still the situation we are living in. And I honestly don't know how it will be resolved. I hope that when this recording is released, the blockade will be over. But this definitely needs a solution. What do you think? Have you seen anything like this before? Because to me, it sounds exactly like political risk.
Well, it's an interesting point, and perhaps Nick could answer it. I can only say that I've done a number of cases, had a number of instructions where there's been a blockade involved, and blockade is often not covered. I'm not sure why blockade is often not covered, but that has often been a difficulty with the adjustment of the claim, is what damage is caused, or is the blockade covered? And even if you might argue that it is covered, and you might say a blockade is something else, you might say a blockade is a civil commotion if it's not government sanctioned, but then you have to establish what damage the blockade is causing sometimes as well, if any. Nick, what do you think about blockade?
Yeah, I have seen it covered occasionally in a policy, in political risk policy, but it's not standard. It's really essentially, I think, a business interruption loss. It's not a million miles removed from export license cancellation, import restrictions, which are covered regularly on a contract frustration policy. So I don't think it's too difficult to add it into the cover of a political risk policy. But again, we will run up against underwriters' inherent hostility to anything that involves non-damaged business interruption, which is what a blockade essentially will be.
Yeah, it seems like something that definitely will be need to address. And just looking to the future, really, when the big war is finally over, hopefully successfully, which areas do you think of the Ukrainian economy do you think will be looking for political risk, trade credit, insurance and investment the most?
Yeah, so basically, once the war is over, we do expect that there will be a lot of recovery and reconstruction projects in Ukraine. So we do expect that the political risk coverage and insurance and the war risk specifically will be highly required for those companies who are going to participate in the reconstruction. So it's the construction of the bridges, roads, different social objects and infrastructure like schools and hospitals. So I think that everything which is related to the infrastructure and energy will be in high demand. But still, agriculture remains to be one of the most important industries in Ukraine because of the export. And I think that the activities related to the agriculture will also need that type of coverage and insurance. And I basically suspect that almost every investment in the future in Ukraine will require some kind of coverage against the political violence risk because of this past experience, and because we still continue to have Russia on the border. Yeah, despite that the war is over, there is still maybe a risk that some kind of conflict may break out in the future. So I do think that this political risk coverage will be very much required in the future, and I do think that this product will be provided not only by the foreign reinsurance companies and insurance, but also by the local one, because the local companies so far have been not very active in that kind of product. They can underwrite some war risk, but to a very limited extent.
Thank you. Nick, what do you think about the availability after the big war is over?
I think capacity will flood back into the market. Why wouldn't it, providing there's a reasonable prospect of a lasting peace? I think capacity will flood back in. I think also there will be creativity and innovation amongst underwriters in refining and developing the product form. I'm not a lone voice on this. Other people are saying similar things to me. So I'm fairly optimistic that the market will respond well in the reconstruction of Ukraine.
I like the word innovation, actually. I like it. I like the sound of it. Our government has proclaimed the Build Back Better strategy. So they want to reconstruct the country better than it was before. So there is no point in rebuilding something in this exactly same state as it was before the full-scale war. So insurance could probably be a part of that BBB strategy.
Well, on the note of building better things, the end of hostilities and the future, I'd like to thank you both, Igor and Lena, for joining us on the podcast from Kyiv. I'm very pleased that we weren't interrupted, and obviously we all hope for a bright future for Ukraine. Thank you again. Thanks for your continued bravery, and hopefully we can continue our discussion at another time. And Nick, thanks very much for coming on and giving us your expertise and your really interesting insights into this situation. And thank you everyone for listening.
Thank you for having us.
Thank you.
Thank you.
Thank you for listening to Risk Matters, the DWF Insurance Podcast. We hope you join us again soon for future podcasts in our series.